Today, we're diving into some of the most powerful wisdom ever put to paper about the stock market. Stuff designed to help us make sense of what can feel like a totally chaotic and sometimes, let's be honest, pretty terrifying world.
Because for so many people, that's exactly what it feels like, right? A giant casino where you could lose your life savings on just one bad roll of the dice. But what if I told you there's a different way to look at it? A way to actually flip the odds in your favor?
Well, there is, and the idea comes from this guy, Benjamin Graham. You'll often hear him called the father of value investing. He stared right into that same chaos and came up with a disciplined philosophy to find sanity and, profit inside of it.
And believe me, Graham learned these lessons the hard way. He was almost completely wiped out in the crash of 1929. But you know what? Instead of just giving up, he spent the next 20 years building this incredibly rigorous system. A system so powerful, it would go on to shape the mind of his most famous student ever, a young guy you might have heard of named Warren Buffett.
So how in the world did Graham solve this investing riddle? Well, his entire way of thinking kicks off with one really simple but honestly profound distinction. And you can't really argue with the results. His star pupil, Warren Buffett, called Graham's book, The Intelligent Investor, by far the best book on investing ever written. That's some serious praise. So let's get into his core idea.
For Graham, the line in the sand was crystal clear. An investment, that's a business operation. It means you've done your homework, you've done a thorough analysis, and you've got a solid reason to expect your initial money to be safe and to get a decent return. Anything else? He just called it what it is, speculation, a flat-out gamble.
Okay, so let's move on to his next huge idea. And this is just a brilliant way to deal with the market's insane mood swings. He wants you to imagine the market as a person, a very, very emotional business partner he calls Mr. Market.
All right, so here's the setup. Picture this. You own a little piece of a business, and your partner, this Mr. Market fella, he shows up every single day. And every day, he makes you an offer. He'll either buy your share from you or he'll sell you his.
But here's the twist. Mr. Market is, well, he's a bit manic-depressive. Some days he's totally euphoric, and he'll offer you a price that's just ridiculously high, completely detached from reality. Then, on other days, he's in a deep, dark depression, offering to sell you his share for pennies on the dollar because he's convinced the business is toast. And this is where the genius of Graham's idea really shines. You don't have to listen to him. His crazy moods don't change what your business is actually worth. The intelligent investor uses these manic quotes as an opportunity. You sell to him when he's ecstatic, and you buy from him when he's depressed. The market is there to serve you, not to tell you what to do.
And that idea leads us directly to what Graham himself said was the central concept of his entire philosophy, the secret sauce of sound investing. And it's all boiled down to just 3 little words.
Margin of safety. That is it. That's the whole motto. Think of it as your ultimate shield against bad luck, bad information, and, probably most importantly, your own human mistakes.
So how does it work in practice? Well, think about building a bridge. If you know that bridge needs to handle trucks that weigh 6,000 pounds, you don't build it to hold exactly 6,000 pounds, right? No way. You build it to hold 10,000 pounds. That extra 4,000 pounds of strength, that is your margin of safety. It's what protects you from the unexpected.
All right, let's apply that same logic to buying a stock. Let's say after you've spent hours doing your research, you figure out that the true underlying value of one share of a company, what Graham called its intrinsic value, is $100. But you don't buy it at $100. No, you wait. You watch Mr. Market get into one of his slumps, and you only pull the trigger when the price drops all the way down to, say, $70. You see that $30 gap between its value and the price you paid? That is your margin of safety. It's your buffer. It's your cushion. So if you're a little bit wrong in your math, or if the company hits a bit of a rough patch, that margin is there to protect your original investment. So when you start putting all these pieces together, you begin to see 2 totally different ways of approaching the market. And these 2 mindsets, well, they lead to 2 very, very different fates.
And the difference is just night and day. When the market tanks, the crowd panics and sells to save what's left. The intelligent investor, they see a fire sale. The crowd is chasing hot tips they saw on social media. The investor is quietly doing hours of research. The crowd sees stocks as lottery tickets to flip for a quick buck. The investor sees them as owning a small piece of an actual business.
And that's really what this all boils down to. Graham's entire system isn't really about outsmarting the market. It's about controlling yourself. It turns out that your own emotions, your greed when things are flying high, and your fear when they're crashing down are way more dangerous to your wealth than any market swing.
And that leaves all of us with a final question. Who is going to guide your decisions? Are you going to let your financial future be jerked around by the daily whims of a moody Mr. Market? Or will you be guided by a rational, disciplined plan that has a margin of safety built right in? In the end, what Graham teaches us is that this choice is entirely up to you.